We are taking charge of every facet of our lives, and this is Take Charge with Sophie. My name is Sophie. In our last episode, we talked about signs of risky investment. And in this episode, we are going to talk about investment vehicles. Over the weeks and in all the other episodes, we talked about investments and the numerous benefits that comes with it. We also talk about the fact that you need to know your own investment objective. You need to know your own risk profile. You need to decide on your investment time horizon before you actually invest. And we've also talked about how to identify risky investments. And now that your eyes are open to a lot about investment, now I want to talk about the actual financial instruments that you can invest in. I will call them investment vehicles. So these are avenues through which you can actually grow your money. There are different types of investments that investors can invest in. So you may decide to do a money market investment or invest in money market instruments. So what are money market instruments? Money market instruments are investments that have maturity up to a period of 1 year. So investments that have maturity up to a period of 1 year are money market investment. Examples of these money market investments are the treasury bills. So 91 days, 182 days, 364 days. So those are money market investments. So those are money market investments. And then also the fixed deposits that you do with financial service providers that may make the treasury bill tenors. Those are also money market investments. Then we also have capital market investments that investors may consider investing in. Capital market investments are medium to long term. So if you are buying, examples of such investments are stocks or shares or equities. They all mean the same thing. So if you are investing in shares, investors in shares should have a long-term investment time horizon because the stock market is very volatile. When I mean volatile, it kind of fluctuates in the short term. But over a long period of time, it evens out and you'll be able to benefit more from it than when you just come in and then you want to exit, by which time the price would have been lower. So some of the capital market investments are shares or equities or stocks, as people may want to call them. And these investments are mostly appropriate for investors who have a higher risk appetite. Higher risk appetite in the sense that you should be able to have the patience to wait when the price falls. You should be able to have the patience for the price to rise. You should be able to have the patience for them to pay dividends for you to benefit and all that. And you should even be able to have the patience if you want to sell and there's no buyer. Because sometimes liquidity on the stock market can be tight when the economy is not doing well, or if maybe the fixed income market is doing better, you realize that the equities market may not be doing so well because they have a kind of inverse relationship. Yes, so equities are there. And then also we have bonds. I know that in 2022, Ghanaians who don't know so much about bonds would have heard so much about bonds because of the domestic debt exchange and the haircuts and all the things that we've heard on the market. So bonds are also capital market investment. They are long-term in nature. So investors can buy, the bonds have maturities. Some are maybe a 2-year note, 3-year bonds, 5 years, 7 years, 10 years, 15 years, and all that. But most of the time, because of the longer maturity profile, they are capital market investments. And then these bonds are often issued mostly by governments. Governments issues bonds, and then corporate organizations also issue bonds. Prior to what we are experiencing in Ghana here, we could classify government bonds as the safest investment one may want to invest in. But I mean, what has happened on the market are actually defied many years of research and basic finance knowledge that government investments are the safest. So bonds can be issued by governments, and they are much safer than the corporate bonds. So corporate bonds are bonds issued by corporate organizations, blue chip companies who raise funds for various reasons. Typically, bonds give the holder coupons. Coupons are like interest, and mostly semi-annually. So you receive your coupons every 6 months. You keep receiving the coupons till it's time for maturity. Then the coupon will come together with the principal that you invested. But there are certain corporate bonds that may not follow the semi-annual principle. They may actually structure the cash flows to actually structure the coupon payments based on when they receive their cash flows. And some of the bonds may pay part principal every period, depending on what they have in the term sheet. So those are some of the things you should consider. So before you buy a bond, you should be very sure of your patience. But the interesting thing is that first, we didn't have a vibrant fixed income market. So when you are buying bonds, you are just worried, people were doing hold to maturity and all that. But now we have a vibrant Ghana fixed income market where, irrespective of the maturity profile, you can sell these bonds on the secondary market to other investors so that you can have access to your money when you need it. The only thing is that secondary markets, the pricing may not favor you, or it may favor, it may be at a discount or it may be at a premium. So at a discount to you, the person who is selling, it means that you're actually going to lose some value and all that. And then at premium, meaning that you're actually going to gain. So that is what the bonds are. And then we have collective investment schemes. Collective investment schemes are mutual funds and unit trusts. Mutual funds and unit trusts are investment vehicles that are very much appropriate for beginner investors. They are appropriate for beginner investors in the sense that you need very little money to invest in bonds, in collective investments, unit trusts and mutual funds, because it's a pool of investment. It brings together, it pulls funds from different investors, and then you invest them, and then the returns are shared among the investors. So there are different types of collective investment schemes or unit trusts. So the types could be money markets. So there are some of the collective investment schemes that will invest primarily in money markets, meaning that they invest in short-term money market instruments. So those ones are very liquid. So if you want to exit, it's much easier for them to make liquidity available to you. And then we have the fixed income collective investment schemes, either mutual funds or unit trusts. Those ones are invested more, they have more allocations in bonds than other asset classes. Those are medium to long-term funds. So you have to be patient because there could be volatility on the fixed income market as well, as we have all seen last year and even this year. That's why the regulator has to come up with a mark-to-market valuation, changing the position from amortizing the assets to marking them to market. So you need to be mindful of that as well. Then we have equities. Equity-based unit trusts are investment that are investing a chunk of their allocations in shares listed on the stock market. So such investments will have maybe 80% or 75% in stocks, maybe have some other percentage in near cash instrument that can make liquidity available and all that. So an investor who has a higher appetite for risk may consider investing in an equity-based unit trust. And also we have the balance funds. So balance funds are also unit trusts that have allocations in both shares and fixed income meaning bonds. So these ones are also medium to long-term funds. So if the fixed income market is doing well, the stock market is doing well, balance funds are very good to go and all that. So in all, as an investor, you need to be sure of your risk profile when you are choosing this unit trust. And then, like I said, the unit trust gives you the opportunity to invest smaller amounts of money, and even in bulk. It even gives you the opportunity to be doing standing orders and standing instructions that can be topping up your investment on a monthly basis for you to grow wealth over a period of time. A lot of the unit trust on the market, it's a minimum of 100 cedis you can start and invest in. Some of the, I think the issuer is ABSA also. So you may also consider in investing in an exchange traded fund. It's kind of a complex investment, but I mean the returns are relatively worth it, and you may consider trying to read around it to see how you can also invest in the exchange traded fund as well. Thank you so much for your time. Share this video with your friends, comment, and also press the notification button so that you can receive notifications or alerts anytime we post. Don't forget to share the channel and its benefits with others so they can also subscribe and benefit from all the life transforming content we keep sharing on a weekly basis. Thank you so much for your time. I always appreciate you spending time to watch my videos. I pray that God bless you even as you take the knowledge you acquire from my videos to take your life to the next level. Enjoy the rest of the week. Bye for now.